Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Council. It's Wednesday, May 29th. Welcome to our Global Markets Commentary. After April's swoon for capital markets, May saw the bulls bounce back as stocks and bonds made solid gains. A 60% diversified global equity, 40% Canadian bonds balanced investor is on track to recoup all of April's decline and then some. The keys for May were fourfold. April's mild cleansing of some overexuberance set the stage for markets to return to rally mode. Economic data continues to show that the U.S. economy is cooling, a good thing when inflation is the problem. While economic activity elsewhere, especially China and Europe, continues to warm up. The outlook for inflation turned more favorable in May as the string of high-side inflation surprises in the U.S. finally came to an end. Lastly, and always most important, corporate earnings continued to be a bright spot. Equity markets, relieved of the first three distractions, took off, with many markets recapturing all-time highs. The Canadian economy opened the year in fine form, but mixed signals are emerging. Job creation remains buoyant, but considering population growth, this is a situation of merely keeping pace. The slack in the labor market is starting to cool wage growth, a key positive development for the Bank of Canada to cut interest rates. Canada has greater sensitivity to interest rates, more variable in shorter dated mortgage terms, and we have a large financial services sector. And this rate sensitivity is showing up. Retail sales in Canada have flatlined for 7 months. Manufacturing activity is a bit weak, and Canada's housing market isn't revving up despite the arrival of spring and some easing of mortgage rates. This is not really a bad thing. But all of these combined would lean toward the Bank of Canada cutting rates. On top of that, Canadian inflation is finally in the green zone for rate cuts. All three of the Bank of Canada's inflation measures now sit below 3% as of April. Strip out mortgage interest costs, and inflation would already be sub 2%. All of this has expectations for the Bank of Canada to cut interest rates between 2 and 3 times this year. We lean toward 3 cuts. We are fielding many questions on what a Canada goes first on rate cuts might mean for the loonie. Currently, at sub 74 cents, the loonie has already moved to price in the expectation that Canada's central bank moves first and a bit more aggressively. So we don't see a lot of currency downside to a Canada goes first scenario. However, the tone of the statement and the press conference can make a difference. Longer term, there is a gravitational pull toward the 76-cent level, but that may take some time. In terms of central banks going in different directions, history shows U.S. and Canadian central bank rate divergence can range from Canada being 2% above to 1% below the Fed. Canada is already starting at 1/3% lower than the U.S. We feel the Bank of Canada could cut by 1/4 point twice without a Fed rate cut. Now, beyond that, and to get the third cut in our forecast, the Fed would have to join ranks. And we believe the Fed will cut twice in the latter half of this year. The desired outcome is a cooling U.S. economy that cements the continued ebbing of inflation. Now, wishing for slower economic growth while wanting robust corporate earnings is a pretty thin needle to thread. But several factors can bring this Goldilocks situation to pass. Slower U.S. economic growth isn't a recession, just less hot. Profit margins and productivity can bridge solid earnings on less economic growth. And both profit margins and productivity are in good shape in the U.S. For the S&P 500, earnings growth isn't just a U.S. story. It's estimated that 40% of S&P 500 revenue comes from outside the U.S. This matters, as economic growth outside the U.S. is showing signs of improvement. So this non-U.S. revenue can help to supplant what might be slightly lower domestic revenues. The bottom line is we are seeing a mix of data. Not a surprising situation when the economy is coming off the disruption of the pandemic, a bout of inflation, and steep monetary policy tightening across the globe. All in all, May's narrative tipped toward the soft landing scenario. Markets have moved to price in some of this scenario, but we see further gains for stocks and bonds should this come to pass. While the media focuses on stocks skyrocketing because of internet memes or Nvidia's spectacular rise on spectacular results, the average stock is advancing in an orderly fashion on solid fundamentals. We continue to see the backdrop as positive for stocks through the end of the year. In fact, we are upgrading our S&P TSX end of 2024 target to 23,500 and reiterate our S&P 500 target of 5,400. But we see the prospect of 5,700 as a plausible scenario for the S&P 500. That's the way we saw the month of May. Thanks for listening, and hope to see you next time.